folks, thank you so much for being so patient. Those were such wise words of wisdom from our commercial sponsors. But we're back with Hannah Kessler. If you were listening in, folks, we were just getting right into it about how you can become your own bank and not have to use the big banks. And Hannah, I think maybe a lot more people are going to wake up to this theory here very quickly, since all the big banks are seemingly going down quickly because of the fraud, because of the fractional reserve banking you were discussing. And it's been sort of a fraudulent system for quite some time now, and it's starting to sort of uncover itself and show its ugly face. So how much more important is it for people today to hear what we're saying about becoming your own bank and using these specially designed whole life policies like the wealthy folks? It's amazing too, Hannah, and I hate to go on this side note, but we were just talking about, oh, it's amazing how some of the wealthiest families in the world, JP Morgan Chase, we're talking about the Rothschilds, the Rockefellers, they've designed the school system to teach us zero financial intelligence and to make us worker bees. And in the meantime, their families have been utilizing these techniques we're talking about the whole darn time. And it's a wonder they say the rich keep getting richer.
Yep. Here's something else, actually, for my folks out there too. Here's another resource: The Creature of Jekyll Island, written by Edward Griffin. Great book. If y'all want to dive in deeper into all of that stuff, I recommend that book out to y'all.
Beautiful.
So anyways, here's something else that I'll bring up too. I totally agree. We have been taught, like I mentioned, from day one to be consumers of the central bank. I think why it's so easy for me to get this stuff, because I am young, all right? I'm second generation to this concept. I didn't have to go through life and then unlearn all of the BS that y'all learned growing up, right? I think that's why it's just so easy for me to get this stuff. But here's really what's going on, right? We are taught that we go out and make our money. I don't care how you make your money. You got to make your money somehow to live on this God-given earth we call America, right? So you go out, you go make your money. Then what are our options? What are we taught? We're taught, okay, I make my money, I can go put it down at the central banks, Bank of America, Wells Fargo, etc., where I can keep my money there and they can use my money. Or I can go leave my money underneath my mattress, maybe dig a hole in the backyard, right? I could keep my money there. Or I can put my money with a financial advisor who thinks they can manage my money better than I can, right?
That reminds me of an IRA or 401k a little bit, you saying
that. There we go. But that's the thing, y'all. We're just never taught properly. We're always taught to be in the controls of somebody else. And so all I'm just trying to say is that, y'all, we better wake up, or you will be in those controls of these central banks and these other financial institutes, financial advisors for the rest of your life. And here's this PSA, because I am here to be effective in your financial life. I am not here to be your friend. So no need to send me a Christmas card or a birthday card, okay? But here's the thing. If you do not care more about your financial life, nobody else is going to care more than what you do. You got to take that control back, and you got to start caring, because nobody else is going to care more about your financial life than you. So that's all I'm doing. And I think a lot more people are waking up, definitely right now, how we're talking here in the headline of the news and the bank closures and even all of the digital currency stuff that's coming out. In my honest opinion, it's all about the control of the American people, but let's not go there.
No, 100%. I mean, the facts are it is. People can call people conspiracy theorists or what have you, but the writing's on the wall. And if people aren't awoke yet to see it, then they're just too far asleep, and that's okay. But, the whole thing, you don't know what you don't know, or you don't want to accept. Okay. But yeah, I mean, guys, becoming your own bank. The fact of the matter is, folks, it's one of the main reasons why the rich keep getting richer. That's just the fact. I want to give an example, if we can, to some listeners real quick, Hannah, and say, I put 100 grand into my policy. You said it grows at what, 3.25%?
That's it.
Per year. So again, folks, let me just make this analogy. It's like putting 100 grand of my money into a savings account. Let's just say, for ease of thought, putting it into a savings account that yields me 3.5% return on my money every single year in perpetuity. That's called compounding. Also, that savings account comes with a very large death benefit so that when, not if, when I pass away, there's a very large death benefit that goes and gets back to the family bank as well, which continues to increase. And so if you have policies on all your family members and everybody's using a family bank, you're number one, earning 3.5% on that money. You're number two, getting tons and tons of huge cash infusions when anybody does unfortunately perish. But also, folks, you can take the money out and utilize it for investments. It's not like our grandpas and grandmas policies they talked about. You can borrow the money. It's specially designed to borrow the money out, tax-free, by the way, and then to invest that money into something like I preach, like maybe mortgage notes, because, mortgage notes can get you quite a nice yield. It's a secure investment with a nice yield, spits off cash flow. Can't be better. So now you've got your 100 grand that's growing at 3.5% a year. You've borrowed out, say, 80 grand of that. That's now growing at 12% a year.
Mm-hmm.
And you're having the cash flow come back that can be paying the loan back off that you've taken from your policy, folks. So it continues to grow. And you can only imagine 80 years from now, 100 years from now, what your family's wealth will be. It's almost just a guarantee, right? And so, gosh, can you imagine the Rothschilds, the Rockefellers, and all these folks that have been doing this for generations and generations and generations, how their family money, their family wealth just continues to grow. And that's what we're talking about, folks. That's what we're talking about. So talk about that a little bit. What does that look like in that example, Hannah? And then what kind of death benefit are they still looking at? And what if they don't pay the 80 grand back that they borrowed out of their policy? Give a little example. How does that all look?
Yeah. Let's use that example. I'll actually use some like real life examples that I've done in my life. So one of them, my house in Florida. All right. I'm originally from Kansas City, like I mentioned. And so I moved down to Florida, and it was dad. So dad found the property. He bought the house in cash. He bought the house from the cash value inside of his policies. And let's just recap why. Because when you take money from the policy, you're never interrupting that growth on the money. What's called opportunity cost. All right. For my folks out there. So he goes in, he finds the property, he takes out policy money, goes and pays cash for it. So, okay, we have the property now. All right. So dad is the mortgage holder, but me, I'm the deed holder. I own the house. And then now I just pay dad my monthly mortgage payments. I'm keeping money in the family. Another one that I did, I like to travel. All right. I like to go camping. I like to kind of live that nomad lifestyle. I got a conversion van. All right. So for my folks out there, those Mercedes Sprinter vans, they convert the back of it to that RV living style. I did that in 2021. And so that project, it cost me some dollars. What I did is I took the money out of my policy. I went down to the Tampa Dodge dealership. I bought the van, and then I hired a guy up in Nashville, Tennessee to do the whole conversion. And so with both of those transactions, I used policy money to do that. Now, because this is a depreciating asset, it's not like my real estate, right? So if I'm using my policy money for things like that, or like a boat or a bicycle, an airline ticket, whatever you want to call it, when I'm using my policy money for something like that, I play honest banker with myself in my life. And so basically all I said to myself is, okay, Hannah, so since you borrowed money from your bank, don't you think it's a good idea that you should pay yourself back plus pay yourself back with interest? Yes. Do we ever do it though? No, right? So now I'm just going to play that honest banker with myself. And now I'm just sending myself back $1,000 a month to my policy because that's what I told myself that I want to do. Do I have to pay back my policy loans? No, let alone with interest? Not at all. This is what I'm talking about with the ultimate control. But I'm going to teach you to play an honest banker, and you should. All right. You should treat your money just like how you treat the bank's money. Because if you don't, you're just saying the banker's money is more valuable than your money. So now let's fast forward. Okay. Let's fast forward. And let's make believe that I'm trucking along and I am age 120 when I pass away. All right. And so I'm age 120. And during my lifetime, I've been using my policies. And at the time of my passing, I have $5 million of death benefit, just making up a number. I have $5 million in death benefit, and I have outstanding $2 million of loans. Here's the thing, policy loans, they are nothing more than a prepayment of our death benefit. So all it is that we are using our death benefit early. So if I'm using 2 million of the dollars in my life right now and I graduate, well, then the insurance company will take my 5 million of death benefit, subtract my 2 million of outstanding loans, and then the remaining portion now will get paid out tax-free to my beneficiaries in one lump sum. And this is where the legacy aspect of this concept comes from, because now you're leaving that generational wealth to the next family, or next generation, I should say.
Yeah, no, I mean, it's amazing because we say becoming your own bank or becoming your own banker, right? So true, folks. I mean, imagine. So you go and you give your money to Wells Fargo Bank. Now, Wells Fargo Bank pays you nothing to hold that in an account there, pays you nothing, next to nothing. And then you want to go get a loan to buy a Sprinter van and remodel the back of it to be a nomad across the country like Hannah, and you want that. Well, those things cost money, and the renovations in those vans cost money. Well, you see, the perfect example, her family has these life policies. They're cash leverageable. So they put the money in the policy. It grows at 3.25% every year. They borrow money out of their own family bank. So Hannah borrows money from her family bank to build her awesome camper van, Sprinter van, to drive across the country, live the nomad life. That costs a lot of money. She could have borrowed money from Wells Fargo to do it. She could have paid an auto loan. She could have borrowed some extra money to do renos and that. And she's paying monthly payments with interest back to Wells Fargo. So Wells Fargo continues to get rich off of your money, period. You don't. Your money is gone. It leaves your family. It leaves your account. Now, imagine put it in your life insurance. You borrow that out and you pay it back to your life insurance with interest, just like you paid Wells Fargo. Being your own honest banker. Can you see now, folks, how the wealth continues to grow, continues to build, and continues to accumulate just like the bank, but for you and your family? And we're going to get right back into more of this. And I know you're not going anywhere. We'll be right back in just a few minutes, folks.